So our next question comes from Donna M. inside of the Rich Habits Network. She says, first, I am so grateful for this podcast and the network that I'm inside of as I'm educating myself and my adult children about smart investing and now asking questions both here and with our Vanguard advisor. Our Vanguard advisor diversifies our portfolio based on our risk tolerance. So we have about an 80-20 split between stocks and bonds. Because the rally we've recently seen, our stocks are now about 85 versus 15, and we told them to leave it that way. They say we're taking on a really big risk. I'm not going to lie, that makes me nervous because I feel like they know more than me. So here's my question. Should I be diversified in not just stocks in the US, but also international stocks? And what do you guys think about this 85-15 split in my current portfolio? Robert, I'll let you kick this one off.
Yeah, Donna, it's a great question. I love that you're a little bit nervous, and I think it's important to understand. Austin and I talk about this all of the time, and we see it on a daily basis, that I believe people are over-diversified into international stocks, and the numbers really don't lie. If you look at the last 5 years of worldwide performance versus, let's say, the S&P 500, the New York Stock Exchange, the top 500 companies in the United States, it has underperformed by 50%. So for me, I always feel I want to go where the money is. I want to look at the math, and I want to stay there because of the opportunity cost of watching my money grow. So in my opinion, I don't think you're at all wrong having this 85-15 blend, because once you get international up to, say, 20% or higher, same with bonds, I feel that you're leaving too much money on the table by not betting on the top 500 companies in the U.S. And so that's my opinion on this. I'm so happy that you're keeping an eye on it because you're going to perform better than most people who just lead a blind eye and let some broker they barely know handle their money. So I think great work. And yes, I agree with what you're asking.
I love that perspective, Robert. Donna, does the Vanguard advisor know more than you? They probably do. They probably have some really cool letters after their name, some certifications, some different licenses, stuff like that. And we don't mean any harm to them, but I would imagine that their job is more focused on capital preservation than capital growth at the moment. An 85-15 split between stocks and bonds, I think, is healthy. That's totally normal, assuming you're in perhaps your 50s and 60s. The mistake people make, and I just want to make sure people understand my perspective on this, which is unless you truly plan at 65 years old to sell all your stocks, go all in on cash, and then live off this cash for the next 20, 30 years of your life, you should stay invested. Now, you could balance that investment. You could have a little bit less risk in your portfolio, but people, I think, make this mistake of, oh my gosh, retirement's 10 years away. If we have a dip, we'll have a dip going into 65, and then it's then I'll lose all my money at 65. It's no. Are you going to live till 70, 75, 80, 85? Probably, statistically speaking, you will. Therefore, you should stay invested into those years as well. And so by staying invested, for me, that means having that 80, 85%, maybe 70 or 60, depending on your risk tolerance, but having these stocks in your portfolio and these equities that are not international in the sense that they don't really have a track record, right? We want to lean into things that have a long track record of growth, which is American capitalism, the S&P 500, the NASDAQ, the total stock market as well. So I just want you to really think about, Donna, how close are you to these retirement years? And then how do you want to spend these retirement years? Do you want to spend them kind of living in fear as to, oh my gosh, is my money just going to evaporate if I stay in the markets, which statistically it doesn't? Or two, do you want to allocate your portfolio in such a way that, yeah, you're going to see some protection from bonds in risky environments, but you're also going to see some amazing upside. I mean, the S&P 500 is up 25% this year. It was up 28% last year, Robert. If you're all in bonds or cash or whatever else in retirement, you won't realize that. Newsflash, that's a 60% gain year over year when you compound it. So it's just so important, I think, for people to stay invested throughout retirement in a risk-adjusted way that makes sense for them. And I don't think international is the answer here.
And I want to add some more to this, and that was a great take. And that is, Donna, and everyone else listening and following along, we're not saying bonds are bad. We're not saying international is bad. Our message is always very clear. Without being too risk on, we want to make sure that everyone has a portfolio that's built for their risk tolerance. When you go into this financial advisor's office, they don't know anything about you. And if you don't properly tell them where you're at and where you feel from a risk tolerance perspective, then they're going to put you in a really safe spot. And sometimes that's okay, especially if you're in your 50s and 60s and you're edging towards retirement, where you want to take some of the risk off the table, take your foot off the gas a little bit. But for those of you following along that are in your 20s, 30s, and 40s, if you take your foot off the gas too much too early, then you leave millions of dollars on the table that you didn't earn because you were so risk off. So I just want to make sure everyone understands that from the different age categories, because we have a very wide audience here to understand the when of how you make these adjustments.
100%. And I will die on the hill that you should stay invested throughout retirement. Turning 65 is not a milestone of woohoo, I get to cash out everything and sit in cash for the next 30 years. That's a terrible idea. You want to stay invested, risk-adjusted returns, understand that risk profile for you. Couldn't agree more, Robert.